So partners, welcome once again for this webinar with our fund manager, Mr. Pankaj Pathak, today evening. First of all, I would like to thank you all for taking your time out and being part of this webinar. What we intend to do today is that we have seen a great secular run in equities for last 3-4 years. And there are some signs which are visible now, which are advising that we should have some bit of multi-asset approach in our recommendations to our investors. So to cover that topic more in detail, we have got Pankaj today. Pankaj is a fund manager at Quantum Mutual Fund, and he's been around in the company for more than a decade. He's a certified financial analyst, CFA by profession and by qualification, I'm sorry. And Pankaj, we would request you to take us through some key points which can be useful for our partners today on the call to discuss it with their set of investors and take the multi-asset advantage forward to their respective clients. With this, I switch off my video camera and hand it over to Pankaj. Thank you.
Yeah, thank you, Mohit, and very warm welcome to all the partners, and thank you for joining us today. So you must be hearing a lot about multi-asset. There's been a lot of coverage about multi-asset in the last 1 year, and by definition, it's very indicative that it's a combination of multiple asset classes. So it can be equity, gold, debt, and all other asset classes. So my idea here is to push how we can put this product or this solution to the end user, to the final investor or the saver. And I'll try to cover few points how this position can be, this product can be positioned, and what problem it solves for in general Indian saver, and how it can benefit you as an advisor as well. So one of the things what I've seen and we have been looking at is retail participation in mutual funds, especially in the last few years, where retail investors have started pushing a lot of money in mutual funds. We see all the SIP flows and participation in NFOs, etc. But with all that, if you look at the overall household financial savings, mutual funds or all these managed money exposure, that is still very small. It's just a drop in the big ocean. So this, if you look at the entire corpus, still Indian retail investors, they have very large fixed income kind of exposure, investment portfolio or their saving exposure. And within that, large portion, you can see almost 45% is in bank deposits. And if you look at the other investment, again, life insurance, which is mainly the endowment funds, again, very fixed income in nature. Currency, we can say that it might be their regular requirement, but many people keep more than required even in cash. And then a small saving or the PPF and all those assets, which has a very high linkage to interest rate. So they all can be considered as an interest rate product. So for investors, there is still some preference for that certainty, the promise of that return. So we have two class of investors. One who are going after all the thematic funds and doing FNO and everything, which are very high risk taking, and they are ready to bet the money. And there are other side where people are not willing to come to even maybe diversified fund. They are still very conservative and being happy with their current asset allocation. Now, the issue with this asset allocation, it's good that you are getting promise of a return, but the promise has been declining. The return potential of this portfolio, which is more linked to interest rate, that has been going down consistently. And going by global norms or trends, whatever we have seen over the last many years and decades across many developed or the even for emerging economies, it seems that this trend will continue as India starts to age at some point. Uh, our demography is already shifting. It's just that the pace is very gradual, and उसका जो impact अभी तक दिख रहा है वो काफी ग्रेजुअली यहाँ पे फ्लो हो रहा है। तो बट ओवरऑल आई थिंक हमको ये एक्सपेक्ट करना चाहिए कि जो इंटरेस्ट रेट हमें मिल रहे थे बैंक डिपॉजिट्स या इस तरह के फिक्स इनकम रिलेटेड इंस्ट्रूमेंट्स में, वो धीरे धीरे करके और नीचे जाने वाले हैं। नाउ टू कंपाउंड दिस प्रॉब्लम इवन फर्दर, what we see is that life expectancy is rising. So in a way, it's a good thing. We are living longer, but remember, we are living longer after retirement as well. So we build our saving in our working age. जब भी तक आप काम कर रहे हो, आप कमाते रहते हो, और फिर आप उस टाइम पे आप सेव करते हो अपने रिटायरमेंट के लिए। तो अर्लियर अगर हमारा रिटायरमेंट के बाद आपको 15-20 ईयर्स का लाइफ फंड करना पड़ रहा था, अभी वो कहीं 30-35 ईयर 40 ईयर का अपने को लाइफ फंड करना पड़ रहा है अपने एक्सपेंडिचर ऑन दैट रिटायरमेंट कॉर्पस, which is again, I'll remind you, is mostly allocated in fixed income instrument and where return is going down. So there is a promise of return, there is some certainty, but that cost is that the promise is going down, that the return potential is declining. So this is one aspect, I think one big pool which is untapped, which we have still not tapped. अगर आप लोग का भी आई एम श्योर आप लोग के पास भी इस तरह के बहुत सारे क्लाइंट्स होंगे जिन्होंने मे भी अपना टोटल पूल से कुछ पार्ट से उन्होंने म्यूचुअल फंड खरीदा है, म्यूचुअल फंड इक्विटी या डेट और डिफरेंट प्रोडक्ट्स में इन्वेस्ट किया हुआ है, बट स्टिल दे आर होल्डिंग अ वेरी लार्ज पोर्शन in maybe fixed deposits and endowments and other things, which where you don't have any role to play. And you can see, given what I have shown in the last 3 slides, how that can have some cost for them going forward. So I think this is the untapped potential where multi-asset category can play a significant role in bridging that gap. So the gap is between their expectation about risk and return and what multi-asset can do. So if you look at this slide, which is a mix of equity, debt, and gold, 3 asset classes in 40, 45, and 15% allocation. This is just an illustration to show how this strategy can work for this set of investor. And what we have seen, this is a good more than I think 11 years of track record now. And what we are seeing here is that the blue line, which is a mix of these 3 asset classes, that has mostly has been better than fixed deposits with slight volatility. So it's not being volatile like what we see in equities, but minor volatility, minor up and down movement, but you are doing much better than fixed deposit. And this allocation has been better off more than 85% of times for investors. Now, even if you look at the rolling return, which I feel is a better indicator. So here we have taken 3-year rolling return, and the orange line shows the SBI fixed deposit, and the blue line shows this multi-asset exposure, which is again 40, 45, 15 allocation. And again, you see the similar kind of trend. More than 86% of time, this strategy has done better for investors compared to fixed deposits. And you can see the return differential. The differential has been widening, and my sense is probably this differential will continue to widen even further. So this is the opportunity where investors, a set of investors who are more conservative, not willing to move and venture into equity directly, and this product can be offered as a bridge between them from the fixed income, fixed deposit allocation to managed money allocation through multi-asset. So it will have some equity component, but the volatility or the risk, overall risk, is much, much lower compared to any equity fund. So I think this addresses one of the concern, and this is the role what this fund can play, especially for conservative investors and for new investors, getting them into the managed money space. And as you know, means I'm I'm kind of speculating that most of you don't have any role in their fixed deposit decision, but in terms of managing the multi-asset or mutual fund exposure, you have some role to play. So getting their exposure into this bucket, that will also uh, they can rely on your assistance and your help to that extent. So that was one part. Other part, what we have seen, the other side of the that spectrum, the risk reward spectrum, where on the other side we have investors who are kind of venturing into all kind of uh, uh, assets, hunting for best possible returns, and kind of carrying very high risk appetite, at least in the bull market. We have not seen, because most of these investors have come after the bear market, so they have not seen the bear market maybe. So, but how we can bridge that gap, how we can address their concern at some point. So the idea is to kind of bridging that behavior gap. Now, behavior gap is there is a beautiful book called from Carl Richards by the name of the behavior gap, and Mr. Carl Richards, he defines behavior gap as difference between the investment return and investor return. So we all have seen that maybe equity, if you have invested in Sensex, in 20 years you have achieved 13% CAGR or 14% CAGR or whatever number. But many of the investors, when you look at their portfolio and their returns, you find their returns are very different from what market has delivered. So market return in this case is investment return, and investor return is their portfolio return. Now, वो जो गैप बन रहा है इन दोनों के बीच का, दैट इज कॉल्ड द बिहेवियर गैप. दिस गैप इज कमिंग अकॉर्डिंग टू कार्ल रिचर्ड most of the time globally, not just in India, but in India also we have some examples. I'll present that. Globally, investor return has been lower than investment return, and that is mainly driven by their own behavior, how they respond to market ups and downs. And this is one element we are facing in India also. So just to quote some example, this is a slightly old, this study was done 1.5 years back by Morningstar Research. And what they draw from their research is that उन्होंने फार्मा फंड्स का एक मैंने एग्जांपल लिया है यहाँ पे, कि उन्होंने फार्मा फंड्स का 3-year रिटर्न देखा at end of April 22, and that was around 23%. But the average investor who invested in the pharma fund, their return was a good 6% lower than the pharma fund returns. And similar kind of a study for a diversified equity fund. So one of the best performing equity fund that time, that has delivered 3-year return CAGR of 40%. That was a phenomenal number, and many investors got attracted. But at the same time, the average investor return in that fund was only 20%. So half of what fund has delivered. Now we rely too much on the past performance data, and we always kind of wish that if we are invested in this fund, we could have gained so much. But somewhere our psychology plays a role, and the cycle of this greed and fear that comes into play, and that's what we are seeing even now. So you can see the flow of money, where investors are moving, what kind of assets they are buying, which kind of funds they are investing in, and most of the time you find they are kind of riding the momentum or trying to ride the momentum. It's not the other way, that where they are looking for value. So there is a greed fear psychology where you run after the best performing thing, and many times avoid the losers. And we have seen, so I have some anecdotes where even one of my friend, uh, he pulled out a large part of his portfolio from equity market at the bottom in March 2020 when market fell. So it happens, but thereafter market rebound. So you never know how it's going to play out. It's always better to have a balanced approach, but our psychology plays a role there, and that kind of creates that behavior gap. This is what Howard Marks defines about investing, and he says that the biggest investing errors that doesn't come from informational or analytical deficiencies. It mostly come from your psychological pieces. So how you respond to markets or how you respond to different circumstances. So this is another area where I think multi-asset fund can play a big role. Now, before going into that, I'll just highlight where we stand now in market, because this is about investors who are running after market in a way. Now, what we see across different valuation parameters, you pull out any valuation parameters and probably you'll get the similar kind of imagery about the market. So the left-hand side chart, it shows the Indian market cap to GDP. So market cap of all the stocks which are listed as a percentage of its GDP. And what we see here is that the market cap to GDP is now 150%. So GDP अगर 100 है तो market cap हमारा 150 हो चुका है. And last time we saw this figure was in 2007, right? At the height of euphoria, which many people called. And on an average, हमने क्या देखा है कि ये market cap to GDP कहीं 70% to 100% के बीच में रहा है on an average, but currently it has moved up quite a lot. Similarly, अगर आप P ratio देखते हैं या price to book देखते हैं या market value to sales देखते हैं, any of the valuation parameters, you'll find we are somewhere above the normal range, somewhere closer to peak if we go by the historical averages. Now, we don't know whether how market will react. It doesn't tell us that the market will correct immediately, because as saying goes, that market can remain irrational longer than you can remain solvent. So nobody knows how market will behave. That is up to market. But we can definitely see all these stats and maybe look at our own risk return profile and how we should adjust and build our portfolio in this kind of market. Now, when we look at all these numbers about valuation, another thing what we see is that in history, whenever we had these kind of valuation or different other valuation metrics, what has been our future return? So forward 5-year return from that point. And what we see, if you can see here at the left-hand side chart, when we had our market cap to GDP more than 100%, mostly we have seen a very low return during that time. So if you are getting at a lower valuation, you usually get higher return in the next 5 years. And if you are getting at a very high valuation, then next 5-year return could be very different. So what had happened in the past 5 years would be very different from what you get in the next 5 years. This is what I want to place on the desk. Same way for most of the other parameters, you will get the similar kind of picture that if you are buying something at a very rich valuation, that can have impact on your future return potential. So there is a need for diversification, and many of the investors, even one of the myth I have kind of encountered with many investors that, okay, I have a very well diversified portfolio. I have kind of investment in 5 diversified equity mutual funds. So that's another issue. I think we need more clarity on that part, that the diversification doesn't mean buying different stocks or different equity funds. It also means that you own different assets, different kind of assets, which are unrelated to each other. And many times you have to buy something that you don't even want to buy, right? So now everybody wants to buy equity this time because you can see the last 3, 4, 5 year performance, and not many people will be interested in many other asset classes. But sometimes it makes sense to buy a mix of all the things. And this is what Peter Bernstein says, that only time you are really diversified as when you have assets you don't want to own. And that's a very important part when you build your portfolio. So this is what we are offering in our multi-asset fund. It's a very simple product, mix of three asset classes. We are trying to make it as simple as possible so that investors across the risk spectrum, they can understand and build their portfolio through it. So it is a mix of equity, debt, and gold. Now, idea is that equity का बहुत लंबा track record रहा है globally of wealth creation. It can give you growth. It can amplify the return on your overall portfolio. So we are trying to get that growth component from equity. In debt, our idea is to get some stability in the portfolio because debt can provide us income, right? You buy a bond or you invest in fixed deposit, you get interest on that. Apart from that, debt has been relatively less volatile compared to equity, and also they are kind of unrelated, we can say, and many times invertly related. So when equities go down, mostly you say debt performance increasing that time. So that is idea to add debt. And gold. So gold is totally unrelated. It has different, very varying characteristics compared to many of the financial assets, which can add a lot of diversification, especially at times of shocks. So, and we have seen that. So I'll just run you through that part in following slides. So this is kind of asset exposure that the fund takes. We have kept the debt allocation between 25 to 55%, gold between 10 to 20%, and equity exposure will be somewhere between 35 to 65%. Now, this is the actively managed fund. We change the allocation of different asset classes based on the market environment. So if you are more optimistic about equity, not that our risk reward matrix is more favorable, then we will be maybe highly exposed to equity that time. But even then, our exposure will be capped to 65%. And accordingly, debt and gold also, we kind of managing all the three asset classes actively. Now, if you look back how these three asset classes have done, and one thing I'll just point, as I talked about gold, that whenever you see big shock, so we had a very big shock in 2008 when you had the Lehman Brothers crisis, global financial crisis, and stock market cracked more than 50%. You can see the 2008 Sensex fell by 52%. So any investor who has 100% wealth in the equity market, there is a risk that they can panic and maybe become more nervous and respond to it, converting notional losses to even actual losses. And this is reality. This happens, right? It's not something which I'm hypothesizing. It is a real thing. Many investors actually do that. At the same time, we have seen gold kind of moving up 26% at that time. So whenever we see these shocks, you see that when fear creeps in, tendency is that you run towards gold as a sector. And similar trend we have seen during the COVID also, where when equity markets fell, you saw big jump in gold prices. So that's the idea of mixing all the asset classes, because no asset class consistently outperforms the other one. We see ups and downs across all the asset classes, and that kind of presents opportunity to one kind of enhance return on the portfolio, overall portfolio, and also to keep the overall risk at a more manageable level. So this is how the strategy has performed. You can see the orange line, which tells you about the performance of the multi-asset exposure, where the blue line is the equity exposure. So obviously the returns will be slightly lower than 100% equity allocation over the years. But at the same time, in down cycles, you'll probably be better off compared to 100% equity portfolio. So this is what I talked about during the COVID, what happened. So 28% drop in equity in the first quarter. At the same time, this exposure, if you build a multi-asset, that was down only 8%. So coming back to the quantum multi-asset fund, as I said, that it's a mix of 3 asset classes, and our aim is to attract these investors who are still on sidelines. They can come, they can have some equity exposure, which will be rebalanced by professionals. So our job, we are getting paid. I'm drawing salary for the same thing, for looking after all these markets, tracking these markets closely, and betting on these opportunities whenever they arise. So एक सॉलिड रिसर्च बेस्ड प्रोसेस है, जिसका हमने प्रोसेस काफी सालों से हम उसको रन करते आ रहे हैं. We had a multi-asset fund of fund, and we have built a multi-asset model sometime in 2011. So more than 12-13 years old model, which we have tested, updated, revamped, done everything with that. So ठोक बजा के उसको हम यूज कर चुके हैं 11-12 साल से, एंड इट हैज बीन वर्किंग फैंटास्टिकली. सो दैट आई कैन टेल. सो एक सेट प्रोसेस है, एक सेट टीम है जिसने उसके ऊपर बहुत लंबे टाइम से काम किया हुआ है. इट्स नॉट समथिंग दैट वी जस्ट इंट्रोड्यूस. दिस फंड इज न्यू इन अ वे. वी इंट्रोड्यूस दिस फंड इन मार्च. बट ये जो हमारा प्रोसेस है जिससे ये फंड रन हो रहा है, ये जो स्ट्रैटेजी हमने वो किया है, उसका हमारे पास बहुत लंबा एक्सपीरियंस है. सो वो आपको इस फंड के थ्रू मिल सकता है कि एक एक्सपर्ट टीम उसको मैनेज कर रही है. आपको मार्केट को लेके बहुत ज़्यादा सोचने की जरूरत नहीं है. यू कैन गिव इट टू प्रोफेशनल एंड दे कैन डू देयर जॉब. It offers that potential that you can enhance the overall portfolio return. So when you look at the return, don't just look at कि आपने 20% इक्विटी में डाला हुआ है और उस पर रिटर्न आ रहा है. आपको इन्वेस्टर को, व्हेन आई से आपको मीन्स आपके सभी इन्वेस्टर्स को, वी शुड लुक एट द ओवरऑल पोर्टफोलियो रिटर्न कि भाई मैंने 100 रुपए का सेविंग किया है, उस पर मेरे को फाइनली कितना मुझे रिटर्न जनरेट हो रहा है ओवर द नेक्स्ट 5, 10, 20, 30 years. And that is this fund offers potential to enhance that overall portfolio return for most of the investors. As I said, this is an actively managed fund, so we have a very dynamic approach in terms of asset exposure. It can move up and down based on the market opportunity and valuations, etc. So I'll go to the process in forward slides. But the point to take here is that this is a very actively managed kind of product. Apart from that, it also brings some tax efficiency. I'll talk about it separately because it's not that fund itself is offering that. Earlier, there was some tax efficiency benefit. Now that is taken away. But still, the fund has better tax proposition than managing your own portfolio across multiple asset classes. So on the process part, the most active allocation goes to equity, which is a growth driver in this fund category. And we are kind of deploying 3 different valuation criteria and different models to arrive at our equity exposure. So one assess the current valuation or the current market level, which is dependent on what is the current market PE, price to book, or market price to sales, and different other valuation parameters. But the primary driver is what is the current price to equity ratio, which is a very popular valuation parameter. Then, so this tells us about the current market condition where we stand in our equity market. Then there is a relative valuation parameter, which kind of compares the equity market's earning yield, which is kind of reverse of PE, and bond yields. So that is another relative valuation parameter which we are implementing here. And then there is a forward-looking indicator. The forward-looking indicator is kind of our own in-house expertise. So in Quantum, we have a very large equity research team, which covers, so we have analysts covering different companies, different sectors, a very wide range of companies and sectors. And for every company they research and track, they kind of arrive at a buy and sell limit. Now, the buy limit, if suppose their buy limit is 80 rupees and their sell limit is 100 rupees, then you are getting the upside, the 20 rupees what you get, that is the upside potential. So this is what tells about the forward looking indicator, because the analyst models to arrive at buy and sell limit is based on 2 year forward earning, कि वो आगे कंपनी क्या करने वाली है, किस तरह का अर्निंग जनरेट करने वाली है, and based on that they arrive at buy and sell limit, and that gives us upside potential, which is more forward looking indicator कि भाई जो होना था वो हो चुका है, जो अभी दिख रहा है वो करंट पी में मुझे दिख रहा है, लेकिन आगे क्या होने वाला है, आगे जो होने वाला है वेदर मार्केट इज प्राइसिंग दैट अप्रोप्रिएटली. तो कॉम्बिनेशन ऑफ ऑल द थ्री, these three fundamental drivers and some filtration about companies, so some governance related filtration and all, we arrive at the equity allocation. So that becomes our equity allocation. Gold is more dependent on the uncertainty index and how the geopolitics is shaping up. So it's a more active allocation ranging between 10 to 20%. And the remaining, the residual goes into fixed income, which is again very actively managed. So NIF equity exposure, our idea is to be more large cap with so predominantly goes into Nifty 50 companies, and then some exposure outside of that, but that is very small. On the debt side, the idea is to manage it actively. The interest rate risk we manage actively. तो हम कभी हम छोटा मेच्योरिटी का बॉन्ड लेते हैं, कभी हम लंबा मेच्योरिटी का बॉन्ड लेते हैं. नो, लंबा मेच्योरिटी का बॉन्ड लिया है वो फॉलिंग इंटरेस्ट रेट इन्वायरमेंट जो अभी जैसा चल रहा है कि आरबीआई एक्सपेक्टेड है कि रेट कट करेगा, अभी यूएस फेड ने रेट कट किया. इन दिस काइंड ऑफ इन्वायरमेंट जो लंबे बॉन्ड होते हैं, अगर आपके पास 10 साल का बॉन्ड है जो आपने 7 साल 7% यील्ड में खरीदा है और आगे चल के यील्ड 6% हो जाता है, तो जो बॉन्ड का प्राइस है वो ज्यादा एप्रिशिएट होता है कंपेयर टू 1 ईयर बॉन्ड, बिकॉज 1 ईयर बॉन्ड लिया है तो वो नेक्स्ट ईयर मेच्योर हो जाएगा और आपको वापस 6% पे ही डालना पड़ेगा. तो इसके लिए ये लंबे बॉन्ड इस समय बेनिफिट करते हैं. तो हमारा डेट एलोकेशन जो है उसमें हमारा आइडिया है कि वी मैनेज इट एक्टिवली, विल मैनेज द एक्टिव ड्यूरेशन एक्टिवली, और जो क्रेडिट रिस्क है उसमें वो हम बहुत मिनिमल लेवल पे रखेंगे. मतलब कि इन्वेस्टिंग ओनली इन very good quality companies or government, so predominantly in government securities. So government के केस में हमारा credit risk अगर देखा जाए तो it's assumed as a zero, that government अपने ही debt पे default नहीं करेगी, which is denominated in rupee. They can print money and pay back. And some government companies which are public sector undertakings, PSUs, which again have some kind of safety because of backing from the government. So the debt portfolio again highly liquid, very low credit risk. We don't want to expose our investors to that part, and managing actively the duration part. And then gold we can achieve from gold ETF. So in this case, we are investing in quantum gold ETF, our own ETF. So this is the mix of different assets which kind of form the multi-asset allocation strategy. Now, I talked about taxation, and I told you that we don't have the indexation benefit now. If you see the long-term capital gain tax, that is now 12.5% across all the asset categories. But there is some advantage here. Advantage is that as I said that आप different asset class लेते हो एंड उसके बीच में जहां पे आपको अपॉर्चुनिटी मिलता है वहां पे आप कम या ज्यादा उनका एक्सपोजर करते हो एंड दिस इज व्हाट मल्टी एसेट फंड विल आल्सो डू. So let's assume you are invested 100 rupees in 2019 in fixed income, 100 in equity and 100 in gold. And now you want to 2020 happen and suddenly equity cracked and you want to withdraw some money. You want to withdraw 50 from fixed income and put that in equity. What will happen if you uh, put redemption or sell that holding, debt holding, 50 रुपए का redemption डाला, उसमें से 30% गवर्नमेंट बोलेगा भाई 15 रुपए इसमें से मुझे दे दो, तो 15 रुपए आप गवर्नमेंट को दे दोगे और केवल 35 रुपए आप इन्वेस्ट कर पाओगे इक्विटी में. Whereas if we do that transaction in a multi-asset fund, we withdraw that 50 rupees and invest the entire 50 rupees in equity. So हमें churning पे taxation नहीं है, and that makes a multi-asset more efficient compared to if investors do it by themselves. So DIY portfolio or the multi-asset has huge advantage because they are not paying transaction taxes every time, and that get accumulated and that compounds over the period. So over the period, you find that it makes a lot of difference in your overall portfolio return. So that is the overall offering here that for investors, अगर वो अपने टोटल एलोकेशन को देखते हैं, ओवरऑल इक्विटी एलोकेशन को देखते हैं और फिक्स इनकम या पूरा सेविंग पूल को देखते हैं, वो सेविंग पूल में कुछ पार्ट उन्होंने और लार्ज पार्ट उन्होंने उनका पीएफ वगैरह में पड़ा है, फिक्स डिपॉजिट में पड़ा है, कुछ पार्ट में भी म्यूचुअल फंड के साथ पड़ा है. अगर वो जो फिक्स डिपॉजिट में है उसको भी वो मल्टी एसेट के थ्रू रन करना चाहें, जहां पे उन्हें हर तरह का एक्सपोजर मिल रहा है, फिक्स इनकम, इक्विटी, गोल्ड, सब कुछ मिल रहा है, एक्टिवली मैनेज हो रहा है, then they can also, one, they can enhance their return. Other thing, they are also getting some tax benefit in a way that long-term capital gain tax you pay when you sell, and that is still lower than fixed deposit. So compared to fixed deposit, the taxation is still better and you can save a lot over the years. So this is a kind of win-win deal for everyone in a way. You also get a larger pool where you can advise and help the investors. So this is all from my side, and back to you, Mohit. And if anybody has any question, I'm happy to answer. You can take all the questions.
Thank you, Pankaj. Quite an insightful presentation, and I have some pre-submitted questions. But before that, I would request our partners, in case you have any question to ask, you can either directly ask, the lines are open, or you can type your questions in the chat box where I will read it out and Pankaj would answer them. But Pankaj, we have 2-3 pre-submitted questions which I will want to ask you on the behalf of our partners. Number one is question is on why only gold and not silver or any other metal in this multi-asset. So if you want to throw some light on it.
Yeah, so yeah, we actually thought about that part when we were building the model for this fund. So there are two reasons. One reason is simple, that we want to keep it very simple, simplicity. So we want diversification, but we don't want to clutter. So many of the assets where we have a linear relation, we don't want to go there. So if you can take that exposure through different route, is better to ride through that. And in case of silver, second, that there is also an industrial commodity, right? So the question can come, why not even copper, aluminum, tin, etc. Now, silver has a larger kind of industrial component driving its prices than normal risk of behavior. And so our idea in this fund is that we can always tap growth potential through equities, and we can get the diversification through gold in whenever we get the shock period. So that was the main reason why we kind of avoided that. We have find that it has been highly volatile and many times moving in sync with most of the equity assets. So that was the main reason why we have it. But simplicity, I think that has some role to play for most of the investors.
Pankaj, second question is on the taxation part, asked by one of our partner. What is the taxation of the fund? So it's pretty straightforward. So the taxation of the fund, and let me answer. Taxation of the fund is actually debt taxation. There are not too many funds in the industry today which comes in the multi-asset category, but still are basically taxed as debt. So ours is one of them.
But now actually, what has happened is that in the recent budget, government has actually took away that indexation benefit
Yeah,
across the board.
absolutely.
So now you see very uniform kind of taxation across different asset classes. And now the debt category, they are defining as if you have more than 65% in debt allocation.
Right.
So multi-asset now becomes the other category where taxation is 12.5% after 24 months. So that is a long-term capital gain. And for
Yeah.
short-term, as Mohit said, it's more like
Margin.
debt taxation where
Yes.
you will be taxed at marginal tax rate. So if you are holding for more than 2 years, it goes to 12.5, and you pay only when you redeem.
Redeem. Yeah.
So unlike fixed deposit where you have to pay on accruals.
Pankaj, another question is in the chat box is the expected return which our multi-asset fund can generate.
Yeah, so I think I can just show this chart and what has been the static set allocation return. And what we have seen, the CAGR is for long period, 20 years, is somewhere around 11% in that ballpark. So our expectation is that these asset classes the mix of all the asset classes over the period, the return should be in this ballpark, somewhere around this figure, what we can see in the history. So historically it has happened, and kind of we expect this trend to continue for maybe some more period.
Okay, great. Next question is on the uh, range, if you can give, while you have shared the asset allocation, but also are there any predefined ranges that we will not be exceeding gold by 20% or
Yes,
something
yes.
of that?
Yeah. So I think I have shown that, but so for fixed income, range is 25% to 55%. Our exposure at any time will be between there. So this percentage of total assets. For gold, it's 10% to 20%, and for equity, it's 35% to 65%.
Can you also throw some light on the rebalancing? When do you do? While you mentioned it is an actively managed fund, but is there a frequency at which
So
you?
yeah, so we actually we review the market very frequently. We have a weekly meeting here, but it doesn't mean that every week we will change the portfolio. So there are two ways. One is that periodic, where every month we look at the allocation part. In weekly meeting, we assess the market, different asset classes and their interplay. And monthly, we look at the allocation, that is periodic, but it also trigger based. So as I said, in weekly, we discuss those markets and we test our models. We look for trigger. If trigger is generated to say add equity allocation, then accordingly market will shift. Or based on relative valuation, if we are getting say fixed income is better place, then those kind of trigger. So it's both periodic and trigger based rebalancing that happens.
Okay. Another question which has come from one of the partners is that he wants to know whether we can share this presentation, which is quite an interesting one, post the session. So, sir, we will check with our internal compliance, and obviously one of our representative will get back to you on this. Next question is, Pankaj, there is some kind of comparison which has come where one of the partner wants to know that currently ELSS funds are basically giving better returns and also some kind of tax advantage. If we compare multi-asset category or multi-asset fund, then how the difference between the two will pan out?
Yeah, I think it's a very large difference actually. So ELSS, one that the exposure is very different, right? So ELSS is mostly a equity oriented fund where most of the ELSS, if you look at their portfolio, they have equities. I'm not sure if is there any multi-asset allocation ELSS fund. I have not seen any such. So that was one part. So in a way, you are allocating to one asset class only. And as I said, that it comes with its own risk and reward. So you get the reward, but you also get the similar kind of risk. And that for many investors is a no-go area. Then other part is the taxation. What you say that taxation, yes, we get a tax benefit. I think it comes under 80C, so there is a limit of 1,50,000. But yes, there is a tax benefit. I mean, multi-asset has no such tax benefit. So even not that 150,000. So that definitely a difference. But yes, there is a cap. So it's a cap how much you can put in ALSS.
These are the questions from the partners. One last question which was pre-submitted, and while you covered it in some bit of it, is that our equity allocation in this fund, what would be the approximate percentage of large cap, mid cap, and small cap?
Yeah. So as I said, our idea is that to keep this product a pure equity play, asset allocation play rather than betting too much on the small cap or mid cap space. So predominantly it will be Nifty 50, but mostly large cap oriented. So we have some allocation. I think it's somewhere around 5% for small mid cap. 95% of our equity allocation is in large cap or large cap space. Yeah.
Okay. So the future potential of the fund looks quite good because apparently large caps are something which is again finding a flavor in the market. So
yeah,
good.
I hope that will happen.
Okay. Sure. There are no further questions, Pankaj. Maybe any kind of closing comments from your side?
Yeah, so I think I'll just place that when we look at the multi-asset fund, what we have seen in the market, that again we look at this fund as a product and place it or try to sell it to investor. But if you start looking at this fund as a solution, asset allocation solution, and address the entire portfolio of the investor, as I said, that investor might have 100 rupees, they have given you 20 rupees to do different mutual funds, but 80% is still with fixed deposit. If you can sit with client and talk about that entire 100 rupees saving, this fund can play a very good role there. Means you can offer it as a solution and then top up through, if you want more equity, then buy some more diversified equity fund over it. And that will give you total diversified portfolio and do top up through equity or debt or gold or whatever you want as per your own risk and return profile. So I think my sense is that can create a lot of traction and that will be very useful for even investor or end user. So that's all. And I think in the current market, it's better to be more cautious and focus on the asset allocation part focus on preserving the saving rather than just running after the momentum. So uh, I think this is one offering which can play a good role there. So, thank you.
Okay, thank you so much, partners. We once would like to once again thank you for attending this session. We hope that you find this session enriching. At Quantum, we keep conducting such webinars on a monthly basis. You shall be receiving the invites from our sales team and our marketing efforts. I would encourage you all to be participant in such webinars, which can be where we try to deliver some value addition to you and some interesting data points which can be shared with your investors so that investors get more confidence and your journey with the investors become much more fruitful. With this, we come to the close of today's session. Once again, thank you, and you can log off now. Have a great evening.
Thank you. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.